Good morning, everybody. I'm Ludovic Souron, and I'm the Chief Economist of Allianz. It's my pleasure to talk to you today about the economic and financial market impact of the coronavirus outbreak. I will speak for about 30 to 40 minutes and then leave room for 20 minutes of questions and answers to the audience. Please use the chat box that was sent to you as a link for the interaction. You can ask questions throughout the presentation, and I will answer them either directly or as we go along. So, the idea of this presentation is to indicate a little bit what we know and what we don't know at this stage. Of course, the presentation that I'm going to give to you today was prepared for March the 30th, and in the past 10 days, we've actually updated again our forecast, so I may jump around a little bit by indicating to you which are the revised estimates for some of the GDP, markets, and trade numbers in the presentation. It's a moving target, but clearly it's one of these events that happens once in a century. So this is certainly interesting to look at this moving target of the impact of the coronavirus on the private sector. To start, I would like to remind us all of the fact that we started 2020 on a very weak note. Political fragmentation with the US-China rivalry, a very low growth momentum across the globe with approximately 10 economies that were growing at 0%, including big economies such as Germany, South Korea, Mexico, but also Italy or even the UK. We also had a series of uncertainties that were looming ahead into 2020, especially the US elections. And we had a series of stretched valuations, especially on capital markets, but also some overvalued currencies, and to some extent also an interesting situation when it came to equity markets. And of course, as of mid-January, end of January 2020, it looked like coronavirus was one of the so-called black swans. Of course, we've heard about pandemics before. It's been approximately 5 type of epidemics that really changed the way we operate in the past 15 years. But this one is different, or certainly will be different. Right now, I don't want to go too much into the epidemiological data. But of course, the main concern is that the number of cases outside of China continue to accelerate. Peak seems close in Europe, but certainly ahead in the US and in the emerging world. And the pandemic per se could actually last all the way through the summer, with several scenarios of exit, both on the health and the economics that I've mentioned today. What is also interesting when you look at the situation is that there's been 3 steps in the development of the economic impact of the pandemic. The first step was clearly the origination of the pandemic was in China, and therefore the first shock was trade shock. Actually, we estimate today that we've lost or we're losing close to 1 trillion of goods and service exchanges per quarter. This is quite unheard of. It's more than 2008, 2009 crisis, and it's certainly one of the most daunting situation for globalization, as most transportation services, shipping, airlines, but also travel are basically on pause for the time being and for certainly time to come. So we've seen, initially it was only a third of the economy that was concerned with the Chinese economy being on lockdown. But of course, very quickly we saw Italy as one of the central nervous system of the industrial sector in Europe. And therefore, the risk of shortages of supply chain unfolded as one of the most important risks in 2020. And then came the second phase of the virus, which was basically the financial shock. We've seen numbers ranging from the worst crisis since, of course, 2008, 2009, when it came to equity derailing. We've seen corporate spread widened for the second time in 20 years to levels unprecedented. We've seen some markets going back as far as 1987. Some people even compare the current crisis with 1914 when it comes to the liquidity shock, but also to the amount of upheaval in the financial market. It seems that first low has been reached in the week of March 23rd. Today markets are slightly rosier, but we expect still that there could be some more disruption ahead, mainly because the negative news flow is not fully priced in, as the crisis in the US unfolds in a very specific, or I would even say dangerous manners. The risk of policy mistake is high, but also the magnitude of the shock unfolds in front of our eyes. The job claims last week actually reminded us of the severity of the shock in a country like the US, where people basically have virtually no safety net when it comes to the job market. On top of the financial shock, and this is really what is the most important in the three shocks that consist of the coronavirus outbreak, the third shock is the seclusion shock. The fact that now half of the world is in some type of lockdown, 3/4 of global GDP is somehow on pause. And so we've revised down our forecast massively. You have on the right-hand side of this chart the GDP forecast for 1 month of lockdown. We are now basing our assumption on 2 months of lockdown and 3 months of exit strategies. So the numbers, for example, that we had 2 weeks ago for the US, which was plus 0.5%, now look like a minus 2.7%. For the Eurozone, we had minus 1.8% 10 days ago when we banked everything on 1 month of lockdown. It looks like most countries will be under 2 months of lockdown, and now the number for the Eurozone is minus 4.4%. We see as we go along with PMI, jobs numbers, car registrations, or releases of GDP, the magnitude of the crisis. This morning, the French Statistical Institute just released the number for Q1, so only with 1 month of partial lockdown, because France only stopped really in the second fortnight of March, and the number is actually minus 6%. We expect the trough of the crisis to be around minus 20%, between minus 15 and minus 20% for the second quarter in most of the economies, especially Italy, France, Germany, but also all the way through the United States. What is important also is that as of now, we continue to expect what we call a U-shaped scenario, compared to what could be called an L-shaped scenario or protracted crisis. What does the U-shaped scenario mean? It means that in spite of this 2 months confinement and certainly this progressive exit of the lockdown, we expect it to last for at least 3 months with partial restrictions in some sectors and some segments of the economy. We do expect that nominal GDP goes back to pre-crisis level sometime by the early 2021. This is very different from 2008, 2009 crisis, where we went back to pre-crisis level only 7 years down the road for some countries. So this is certainly a very severe shock, and the unfolding of events, especially the policy choices when it comes to the exit of the lockdown by authorities, to certainly shape the U and the length of the trough of the U. But we continue to believe that because there is no destruction of physical capacity, and even though there could be some changes structurally, the overall economy has been put on pause but not damaged in any case. In addition, which is really what matters, is that policymakers have actually stepped up to the plate very early on to protect the web and to make sure that they will prevent this crisis to infect the financial system. Before I go into these policy responses, on slide 11, you have the different scenarios between the U-shaped scenario and the protracted crisis, where you see that the depth and the severity of the crisis and the protracted crisis assumption is actually quite daunting. But already here under the U-shape, you see that insolvencies could go up as much as 20 to 25% globally. Global automotive in volume of sales could go down as much as 18%, and global trade will certainly collapse by another 10% on top of the growth numbers that you see here. So I mentioned policy response. Of course, there is a trade-off. Both the health authorities and the economic authorities are trying to flatten the curve. The health authorities are trying to avoid congestion in the emergency room, but economic authorities, both central banks and treasuries, have been trying to mitigate the severity of the recession and to make sure that economic interconnectedness could actually survive through the crisis. It matters especially for jobs and for companies, and these are the two objective functions that most of the policymakers around the globe, especially in Europe, in the US, and in China, but also right now in the emerging world, are trying to pursue to avoid that this crisis actually creates some type of a structural regime change when it comes to growth, when it comes to business activity, and certainly when it comes to scaring effects. So on the fiscal side, we've seen between 3% all the way to 10% of GDP of additional spending. The table is actually not even up to date. Germany, for example, tripled the amount. If you add the handout through short-term employment opportunities and the guarantees offered by the public bank. The US is also talking about another $2 trillion, so doubling the 10% of GDP of expenditures that are mainly going through tax deferrals, state loans and guarantees, and handouts. So all in all, if you compare with 2008, 2009, for example, there was also a very smart and very quick fiscal response, but maybe not to this magnitude. Just a word on the magnitude of this crisis. It seems huge, but because nobody has an idea about the severity of the shock, it is an insurance policy. It's just showing that Treasury, Ministry of Finance are ready to do whatever it takes, but it doesn't really give you the final number yet, especially as more people are asking for partial unemployment opportunities, for example, in Europe, which is one of the strong policy choices that were made. And in the US, President Trump, for example, is thinking about doubling down with an infrastructure plan to the tune of also $2 trillion to make sure that on top of the relief emergency efforts, there is the reconstruction efforts. So that gives you a bit of an idea. If you just take the US as a compass for what we are looking into for the other countries, especially those countries that have actually had lower ambition when it comes to the fiscal response to the coronavirus outbreak. More importantly, central banks actually stepped up their game much faster and much smarter than in 2008, 2009. If you look at what the Fed has announced, the ECB, but also the People's Bank of China, they've really basically indicated that they're ready to do whatever it takes and to go unlimited with purchases of assets under liquidity stress. This was very important to calm down spread widening on the corporate side in the US. This was also very important to calm down spread widening on the periphery Eurozone markets. So this worked. Central banks won, and markets calmed down very vividly in the last week of March. But there remain some issues, or at least some pockets of risks, especially the risk of rating agencies derailing again markets, the risk of markets not fully pricing the extent and the severity and the length of the recession. And to a certain extent also, we see that if governments were to have to do more, central banks may have to also rethink how they act directly into the economy, especially public debt monetization. And you even hear some fantasies about helicopter money and central banks distributing directly cash to the households to maintain the supply fund. I don't think we are there yet, but certainly we see that this policy mix has been very reactive and very sizable to avoid a so-called L-shaped recovery and to maintain the economy under life support for the time being. Of course, the duration of the epidemic and the expectation management will matter enormously when it comes to the efficacy of these policies in restoring demand after the peak of the epidemic. I just wanted to go quickly through some of the real economic challenges. So let me maybe talk about jobs and talk about firms. Jobs is, of course, one of the more worrying side of this crisis because it's a liquidity shock on many businesses. So here you have, for example, the estimates for Europe. As much as 65 million people could be in need of some type of short work opportunities, partial employment benefits. We estimate that there is, unemployment rate could double in some countries, at least temporarily. In the US, the unemployment rate is expected to triple to above 10%, as you've seen the job claims number go as high as 10 million people in almost 2 weeks of epidemic fears. So it tells you a lot about the differences between Europe and US in managing the unemployment situation in the aftermath of the epidemic. Right now, we see the US companies reacting very quickly, and the government also proposing some public employment schemes and some ways to mitigate the effect. But in Europe, the idea was to use partial employment, which was a response that Germany used during the last crisis. That's been very effective. We're even talking, as we speak, about an unemployment scheme at the European level to top up some of the more patchy unemployment schemes in some of the Eastern European countries, or in some lines of businesses where maybe the contributions from salaries is not as much to maintain a fair share of the net salary during partial employment. Similarly, the number of companies at risk is actually in Europe again as much as 13,000 companies that were already in liquidity distress before the crisis because of demand and profitability and liquidity, mainly in the service, construction, and retail sector. And of course, we expect that these 13,000 companies in these 5 core Eurozone countries will actually not make it to the next step because it's 2 to 3 months shock on turnovers. And in Europe, for example, we expect turnovers to drop by as much as 25% in the second quarter of 2020. I remember when people tell you that GDP will certainly go down by 15%, you have to think that in some countries, half of the GDP comes from the public sector, which is kept at zero, and the real shock is actually twice as much in the tradable sector, in the private sector. So all in all, we expect an increase of insolvencies globally of around 14%. It really depends from country to country, but it is basically between 5 and 20%. This is a low bound for some countries, especially the US. We expect indeed 15% for China, 16% for Europe, and 7% for the US. Our latest estimate, especially looking at court proceedings, show that the US could actually have a surge of bankruptcies by as much as 20%. So tripling what we have expected 2 weeks ago. What you see though is that the increase in insolvency that we expect for 2020 comes on top of 3 consecutive years of increases in insolvencies. So the disruption in the business sector was already quite high, and it's supposed to continue in a very strong way in some sectors. Maybe let me give you a bit of insight about some of the sectors, and I'm happy to answer some of the questions you may have. The shock was very strong on the transportation, energy industry because of the triple shock, especially on trade, finance, oil prices for energy, and then the seclusion shock. And then the next sectors that are partially affected, of course, automotive, because it's a very split supply chain, retail, especially retail for whites and brands, semi-durable retail, because of the seclusion shock in most of the economy. We also see some pockets of risk in machinery and equipment and pharmaceuticals, because these are sectors where the cash flow needs are immense. And of course, in some countries, some of the cash flow are bridged by the public sector, but in other countries, this doesn't happen. So no stone is left unturned when it comes to the sector impact of the coronavirus crisis, but the impacts are very different. For some of them, it's a full top-line impact. For some others, it's more of a profitability impact. For some of them, it's clearly a liquidity impact on the outskirts of the crisis. Because what you need to remember on this insolvency trial is that it's not necessarily now that we're going to see a peak in the bankruptcies, but it's actually 2, 3, 4 months after the epidemic actually recedes, likely that we're going to start, after we pause basically the economy, which are the companies that could actually not make it after these 2 or 3 months of pause. So we need to be very vigilant in the exit strategies of a lot of the countries, especially those economies that are trying to rewire the economy sector by sector. But we also need to be very vigilant with credit risk on the outskirts of the crisis, because this is where the bulk of the economic costs and losses related to the epidemic will happen, especially in the second half of 2020. Slides I'll be slow to move. I just want to quickly go on the 2 or 3 main areas. So here you will see that you can find all of our presentation on allianz.com/economic research. You will see in particular this study about sector by sector impact of coronavirus. You also see something about emerging markets. You also see a few stuff about the jobs market or capital market. So please don't hesitate to let us know if you need more. Just wanted to go quickly through the US, China, Europe, and the emerging markets. So in the US, as I said, the issue is the severity of the shock, which we expect to be now minus 2.7% of recession in 2020, which of course the bulk of the shock in non-residential and residential investment, but also in consumption and government spending, trying to save the day, but with very little effect when you look at the negative wealth effect of the precautionary savings, and also the lack of opportunities to consume and the losses in salaries. This is quite a perfect storm for the US, and of course that's why we expect the unemployment rate to triple, and the policymakers have been trying to do their math when it comes to responding to the crisis. As I said, the Fed and Treasury went unprecedented, from sending checks to households, to guaranteeing pet sick leave, to giving credit guarantees to low-income families and companies, to authorizing loan forbearance. And so we are quite confident on the size of the response. Of course, there are 2 caveats to that. The first one is 2020 is an electoral year in the US, and so the second half of the year will be quite pivotal for President Trump. And so the risks of enacting policies that will have lasting effect is high, and so we need to be careful about some of the risks taken here, especially should the stimulus double to 4 trillion instead of 2 trillion. The debt to GDP level in the US could actually surge to almost 120% at the federal level by end of 2020. So it's quite a massive increase, and of course this is something that shapes in a very different way the possible intervention of the government in the state of business, especially as some possibilities for temporary nationalization of businesses. I'm thinking here about airlines is also something that has been voiced in the US, which is something that usually is more of an European type of threat to some of the sectors that could be in need of temporary assistance. So the situation is being scrutinized, especially when it comes to the risks attached with this crisis. The health and sanitary costs will be immense. The insurance costs will also be high, and to some extent, the overall management of the crisis will also decide on the shape of the recovery for the US. So for me, the U-shaped scenario is maybe the most likely in the US because of the way the economics work, but it's also where the threat of too much tempering from authorities in the state of business could actually change and create bankruptcy down the road. I'm thinking about small banks, I'm thinking about large bankruptcies of companies. For example, some of the decisions that have been taken by the Fed to directly intervene on the corporate market for investment grade has left out some of the high yield companies. So those companies that go to the market and finance themselves at a much higher cost. And so we need to be a bit careful with what can happen on these tail risks for big companies, but also more generally for the exit of the crisis, as the US was trailing Europe for a good 10 days and has been slow to put in place some of the lockdown effects. In Europe, maybe let me talk about China. In China, of course, the shock, China was first in, first out. We expect growth in China in the first quarter to be as low as 1%. You see the pre coronavirus forecast of a very flat line for GDP growth, around 6% growth per year, and now the orange line is actually showing what we expect now to be the evolution of GDP growth for China in 2020. We still continue to think that China is actually recovering and could actually grow as much as 4%. What is interesting is that the numbers out of China show that production has restarted, but that consumption is actually having troubles restarting, especially service expenditures, leisure. And so it shows that even though you can restart the manufacturing engines, all of the attempts by President Xi and Prime Minister Li to move towards a consumer-led economy are actually put on pause by this coronavirus epidemic, because it changes everything when it comes to the type of growth we will have in China. And it actually resonates quite well with the amount of the policy stimuli that have been put in the economy to get out of this crisis. Of course, the relief operations were massive and were very impressive and very timely, but also the size of the fiscal stimulus package, which is close to 5% of GDP, comes on top of almost 5 consecutive years of 2 to 3 to 7% of GDP put in the economy to make sure that growth would be about 6% for the past 4 years. In addition, a lot has been done on the monetary side with cutting the reserve requirement ratio by banks and putting additional liquidity into the market. This is important because we see that the epidemic has an effect on the real estate sector, especially commercial real estate, and this is one of the sectors where the leverage was the most important in China. But it's also important that there is this policy mix in China, because we saw some vulnerabilities on the currency, but also on the business disruptions. For example, China in 2018 and 2019 has had an increase in bankruptcies by almost 40%, twice in 2 consecutive years in a row, which shows that we already had quite some turbulence when it came to the private sector in China because of the very strong leverage, but also because of the changing demand, especially from the US with the US-China trade war, but also when it comes to the competitiveness of the Chinese manufacturing and the reliance on China for the state of supply chain. The Chinese companies were not able to price as much as they would like the costs that they were bearing on China soil as wages increased and so forth and so on. So China was very fast and very smart in unleashing policy mix, which actually was followed through in the rest of the world in a similar way, even though, of course, whatever is done in the US, especially by the Fed, has a much more rippling effect to the rest of the world. And also the stimuli that we see in Europe, in the US, will certainly have a bit more effect outside of the European single market in the US than whatever stimulus has been done in China this time, which is very different from 2010, when it's really the Chinese consumer that saved the world. This time around, this has been a bit a bone of contention with between the US and China. The impression that China has not done enough when it comes to boosting the economy. And I personally believe that China has done a lot, but in a much less cooperative way. So it has been about boosting growth domestically, less about boosting the Chinese consumer, and as a result, making a new outlet for companies across the world. If you look at Europe, the idea is that we have, especially for corporates, that we have this slide, that we have indeed one of the slowest momentum for European companies. We can expect turnover drops by as much as 25%, as mentioned before, and profit margins to go down by, on average, 1.5 percentage points, but in some sectors, as much as 5% on gross operating margins. Why this is important? Because the choices are made by policymakers in the severity of the confinement, but also the exit strategies. And we see a lot of disorganized exits happening as we speak. For example, Austria and Czech Republic decided to exit faster than some of their other European counterparts. And this is creating a bit of tension on who will be ready first to get market shares on the exit phase of the crisis. And this is also important because in some countries, the policy actions are very different from other countries. So, for example, in Germany, the choices that were made to support businesses were very strong. We're talking about almost unlimited public guarantees to some of the Mittelstand companies, whereas in some other economies, like Spain, the support was much less. And it was more focused towards households and less towards businesses. So this is creating an uneven situation between companies in the single market when they've all been affected by 2 months of lockdown, certainly 3 or 4 months loss of turnovers. And so that's something that will certainly have a differentiated impact when it comes to competitiveness between companies of different countries in the European Union. Maybe a word on emerging markets. So, of course, the main problem for emerging markets is that the peak of the epidemic is ahead, but also the sudden stop of capital flow and these depreciating currencies are creating a perfect storm for corporates in emerging markets that are indebted in hard currency. And that's why you've seen, the troubles in Argentina, for example, or now the troubles looming ahead in Turkey, but you also see concerns about Mexico, South Africa, to a certain extent also Southeast Asian markets like Malaysia and Indonesia, which have maybe less room to maneuver when it comes to either monetary or fiscal. So in emerging markets, one of the issues is that they don't have the whatever it takes that the other economies in Europe and the US or China have. Sorry. And so as a result, they have less room to maneuver to respond to the crisis, sanitarily, because of the protectionist measures that have been taken on health supplies, fiscally, often because they are either more indebted on average than some of the northern hemisphere countries, or because there is less appetite towards their debt in an environment where flight to quality and search for safe havens is actually very strong. But also monetarily, because of course currencies are the first ones to adjust, but also central banks in the emerging world have a signature that doesn't allow them to do, for example, quantitative easing to the level that they would like to. Some countries are actually crossing that line. Think about South Africa here. That will certainly be a lasting effect when it comes to the credibility of the inflation targeting or the risk appetite of investors to go and lock some capital and some investment in some of these countries, because the backdrop against which they will operate will be less visible, or at least less obvious, and certainly less stable. And this is something we need to keep in mind, because right now emerging markets have a little bit of support from the IMF and the World Bank, but it's still in size very small compared to the size of the economic shock due to the coronavirus outbreak. So we expect that emerging markets could actually experience even more tensions down the road as, of course, the health situation deteriorates, but also some of the policy tools are maybe harder or less efficient than in some of the European, American, Asian economies. A few words on some countries in each of the regions. In emerging Europe, the big concern for me are more the economies that were overheating, like Romania and Hungary, because the health shock is important, but also because the central banks have been very lenient already with interest rates, so there is less room to avoid a sizable recession. I'm less concerned for Poland or Croatia. To some extent, what is interesting in Eastern Europe is, of course, the trade shock is very important because of the exposure to European outlets. But the fact that they are benefiting from the liquidity injection by the ECB is something that is quite positive. It's not the case for the Russias and Turkeys of the world, but it certainly is the case for the Eastern European countries. Maybe a word about Russia. Russia is, of course, affected very much by the oil price shock, like a lot of the net exporting countries. But Russia has experienced this renationalization of some of the industries after the 2014 shock. So it seems that Russia is slightly more resilient in the way the economic effect will destroy or deteriorate some of the private sector capacities of production. After the 2014 crisis, Russia decided to restart a lot of the domestic sectors, from agri-food all the way to car manufacturing. And this is something that could actually bring some type of solace in the second part of the crisis because of the lesser reliance on the rest of the world, including for financing, with some of the sanctions that have been put in place. If I look at the taking some time to move. If I look at the Asia Pacific region, the countries that have the less monetary leeway are Vietnam. In the smaller countries, in the big countries, the room to maneuver is not as important as one could expect, especially for India. But it's certainly Vietnam is where I'm a bit more concerned when it comes to the monetary policy leeway. For the fiscal policy leeway, Malaysia and Vietnam again are part of the countries that maybe would be less tentative to do a strong stimulus to restore economic activity. So all in all, I'm in the Southeast Asia region. I think most of the measures have been taken to lessen or mitigate the recession, which is going to be quite important, especially in the trade hubs, the Hong Kong, Taiwan, and South Korea, and Singapore. But in the ASEAN economies, for example, the restart of China will actually be instrumental in determining how strong and severe the effects of the shock will be. Some countries like Thailand will be very affected, and the currencies have actually reacted this way because of tourism revenues lost. But for the manufacturing countries in Southeast Asia, the question would be indeed about the Chinese outlets. For some of them, this is basically 40 to 60% of their exports. If we go to the to Latin America, where is the slide? Acting up. In Latin America, all of the countries were in recession in 2020, either because of their double exposure to the commodity shock and to the US, or because of the little room to maneuver, especially in the monetary, but also in the fiscal space. So we expect quite a severe contraction of the Latin American continent, and some troubles ahead with currencies. financial cycle, especially for Mexico, but also we've seen what's happening now in Ecuador. So some of the dollarized economies are having trouble. And we also see that the big economies, especially Argentina, which defaulted 2 days ago, but also Brazil and Mexico, are really to be watched because of the severity of the health crisis and the inability for Brazil, for example, to enact a full confinement. Maybe a word on the Middle East. We had similarly some countries that were a bit on the watch list because of the oil exposure. I'm thinking about Bahrain and Oman, for example, as small countries that were very close to a balance of payment crisis. But of course, the trade and financial hub of the UAE will be particularly affected also by the deceleration in the US, Europe, and China. We also see, of course, the effects very important in Iran and Lebanon that were already in crisis before the coronavirus outbreak. What is interesting here is of course, the severity of the shock, the ability for some of them to use stimulus measures, but the problem is indeed their super dependence on whatever is going to happen in the US, in Europe, in China in the next 6 to 9 months. And the choice could be for some of these economies to really put a lot of the liabilities of the public sector. So to re-administer a large chunk of the economy to avoid that the losses would be more important than what we've seen before. In Africa, of course, a lot of the countries are in a very difficult situation to weather the shock. We see green shoots, for example, in Morocco. But for me, the countries that I'm worried about are South Africa, Congo, Algeria, Angola, and Nigeria. So mainly the commodity exporters in large economies that are quite financialized. We also see Ghana as being a bit in the center of the storm because of the balance of payment vulnerability. Gabon also is a country that I'm particularly worried. So the corrections in GDP will be important, but also the risks for some of these economies to resort to debt issuance when they won't be able to repay their interests is something that has been actually singled out by several political leaders at the G20 to see whether there could be some type of moratorium on the debt repayment of some of these countries in the emerging world, especially in Africa. So either Eurobond repayment or debt write-off for Chinese creditors is something that is, of course, on the table. I don't think it will suffice because it will just soothe the financial stress, but it will not solve the inability in some of these economies to actually enforce a lockdown. And therefore, the food security shock, for example, that it could create in some of these economies, or the trade shock it could create in some of these economies if the rest of the world is not necessarily ordering any more agricultural products. For example, I'm thinking about Ethiopia, Kenya, Uganda here, or the overall integration of the financial sector. Should there be less appetite towards foreign direct investment and portfolio flow into the emerging markets of Africa? Maybe to finish off, and then I will open for question and answers. I would like to talk quickly about, of course, the canaries in the coal mine, re-rating risk. I talked about the rating agencies, liquidity crisis. This seems to be calmed down as we speak, which is good. What is less, I would say, sure is whether policymakers will be able to avoid the policy mistakes in the exit phase, especially as you replug some part of the economy. Are you sure that you're not making more damage to the economy by delaying some of this recuperation or by tempering too much with some of the way this recuperation should happen? And this is something that we need to keep in mind and watch constantly over the next 6 to 9 months. For me, it's a 1 year type of cycle. It's a marathon, so we need to be very careful about what could go wrong in the second part of the crisis after we've overcome the first part, which is really the peak of the health and sanitary shock. On the structural consequences, I don't want to go too long into this, but if you just think about how the world could look like after this crisis, I don't believe about a grand, transformation of capitalism, etc. But I do believe in 5, 6 big ticket items. The first one is I think governments will be even more interventionist than before. This is a trend that was very present across the world in the past 5 years. And I think we should expect governments to be even more assertive and to strengthen their role, be it through regulation, but also through direct intervention. As we've seen, a lot of the policymakers are looking for ways to go direct to their constituents. This is something we need to keep in mind because that changes a little bit the weight you put in your companies in public affairs. Globalization, of course, as a lot of countries are looking into reshoring some of the activity. People talk about industrial autonomy instead of talking about protectionism. On the financial market, I think the size of the shock will certainly change a little bit the risk appetite of some of the less sophisticated investors, and so that will certainly call for safer products and placements. We expect actually real interest rates to remain depressed for at least decades after this shock, which is something that we've seen in the past as being one of the consequences of pandemics. At least that's what academic research points to. Chinese soft power is of course one issue because China was first in, first out, and so of course China is trying to is going to be the producing capacity center for the world for at least the next 3 months. And so this is creating a lot of worries in other regions of the world that China goes on to a shopping spree, that China may actually gain market shares, or that China will definitely win over some type of sectors at the expense of others. And I think it's partly true, and you see the rivalry on information, but also on economics and on coordination. And so I think this will certainly aggravate the situation before the crisis of U.S.-China rivalry, but not necessarily change it that much, at least to my understanding. This maybe risk awareness, of course, for the insurance industry. This is a wake-up call, at least for the collaboration we have with public authorities, how to address such a systemic shock, which was very low on the agenda of a lot of risk managers. If you look at the WEF or the even the AGCS risk barometer, I think pandemic was number 17 or something. So it was really on the back burner, and now it's going to be on the front burner, and we're going to have to invent solutions together because these don't exist, especially as this risk is by nature covariant and by size unprecedented. And maybe this pandemic is just a test run to more of these sanitary shocks. I think that whatever innovation we've found in our response to climate change or cyber, we need to really think how we could apply it to health shocks going forward as an industry. And the last one is, of course, the change in productivity with home office being more generalized. I mentioned the effect that it will have on commercial real estate. But more generally, I think it will definitely change a little bit the way we think about jobs and, where you work, how long you work, and whether you need to be in a certain location in a certain slot. And that for sure will change, especially the reshoring, offshoring debate. I think we actually may see a lot of reshoring of goods production. We will continuously see a lot more offshoring in the service sector because we understand that we can actually have people now abroad doing exactly the same level or even better when it comes to their tasks than those that are being physically in the office. So I think it will also change definitely our expectations around digitalization of back office function and so forth. So with this, I will stop here and I will welcome any question you may have. So I remind you that you can ask them in the chat box and or you can send me emails or um, send emails to your account manager that will then forward it to me. So let's see if we have some questions. So Frank asked to send the presentation. Hi, Frank. You can find all of our research on allianz.com/economic research. And so you will find this PowerPoint, you will find reports with the story written, but also you will find other additional blogs, such as the sector study I mentioned, emerging markets, and so forth. So the recovery in Asia compared to Europe and the US, it's a very good point. As I mentioned, I think it will really depend much more on China. So I think Canoe countries, so smaller Asian economies, will be very affected by the triple shock because it's a trade and it's a financial shock, but it's also a demand shock in the north. And so for Singapore, for example, this is a massive shock, causing almost 3% of recession. But the government has been very quick to start a stimulus, and there was actually room to maneuver. So I would expect those economies to really recess very strongly, but then to pick up very quickly because they are used to these shocks. Remember that in Asia, most of the economies have experienced at least 3 huge, if not 4 huge crises in the past 20 years. In the past, 25 years. And so they are used to this and they've built resilience. What could really change is, of course, I think the Asian economies will have less intervention by the government, especially in business activity. So that means that job losses, informalities, bankruptcies will be more than in Europe. But then there will be less deadweight losses and there will be less windfall effect. And so the recovery will be safer, at least more, it will be sounder. It will be less intervened upon. The second thing is because of the pacing of the crisis between China and the other economies, I expect that the Southeast Asian markets will actually become or go back to be a bit more dependent on China. And so for some economies that have tried to distantiate themselves from the Chinese dependence, and think about Indonesia here, this crisis will certainly have an effect on prioritizing some of the Chinese outlets and trusting China to be a bit of the go-between to get to the international markets, as the rest of the markets will be quite difficult to navigate. Of course, as I mentioned before, the exit strategies of some countries will also consist of being much more protectionist. So for some of these Asian economies that have banked everything on exports, this is really time to rebalance towards domestic growth engines. This has always been time to rebalance, but I think this is one of these other wake-up calls that means that we really need to, we as in policymakers in Southeast Asia, as if I were one of them, but they really need to focus on deepening the non-tradable sectors of the economy, on strengthening the intermediation of some of these sectors, on ensuring that they are complementing each other when it comes to the supply chains much more, which it is a call for more integration, for example, in the ASEAN bloc. It is certainly a call also for some of the larger economies of the bloc to really rethink their industrial strategy, and especially when it comes to equipping the middle class in the countries, instead of going after demand in the north. That will take some time, and that would be certainly a bit warped, I would say, in the first phase by public intervention, by the will to relocate some of these productive capacities closer to home. How will COVID-19 influence the insurance market specifically? Well, I think first we're going to be impacted with gross written premium losses, with investment income losses. We may have some green shoots when it comes to motor claims because people are driving less. Okay. But I think what is very important for me is the changes it creates in how you address this type of systemic covariance shock. is it something that will always be handled by the public sector, or do we need to have a public-private partnership in addressing these sectors? So it's really about inventing solutions for business interruptions, for health shocks that include some insurance capacity, which basically didn't exist because there was no cover, no premium, and therefore no hazard that could actually trigger this cover. So I think it will change also this side. I think it will also change a bit the private health insurance market. I hope that this crisis will be changing a lot of things here and there, but my sense is that right now a lot of people are philosophically thinking about this the aftermath of this crisis. So this is not something that will necessarily change so much. The only thing is that I think there will be a lot more investment in health infrastructure, which has been a bit underinvested in the past years, and it will be about the business community entirely to rethink what it means to be working on or in an environment in which you can have this type of shock on the health sector. Is AGC, in your view, will the COVID pandemic help propel Biden into the White House this year? I wish I knew. I believe that this is not good for Trump. Yeah, that's my view. But when you have such an uncertainty shock, history shows that people tend to go with the incumbent, just because they don't want to have someone that could not be able to handle this crisis. But it will be hard to see someone handle this crisis worse off than President Trump. So I believe that there is a high chance of a Democratic candidate in the White House at the end of the year. But President Trump is certainly quite impressive in his way of reacting to such a crisis, and he's trying to do his best. And I see some gravitas in him built week after week, including in less goofy moments, and certainly much more. He's ready to push through the Senate, for example, to go beyond their means, which is something that is I think quite interesting. His leadership style is very different, but it's actually not too bad when it comes to being reactive and certainly being very bold in the type of intervention that the U.S. government could do to help the most in need. Emily, the trust in the financial market change, and can I comment if Allianz is shifting the strategy for investment? Well, Allianz is a long-term investor, and Allianz is a very, I would say, precautionary investor. So we, of course, be protecting our balance sheet like any long-term investors. So we are doing our best to maintain investment income, to maintain return, to maintain our solvency ratio. It's a very volatile environment. It's, of course, a lot of market capitalization, especially in the equity markets, change at least the risk appetite for everybody, including us. We went to more for risk-off strategy when it comes to equity exposure. But I think the long, at least the values and the principles, which are about securing the future of the people that work with us, which are about ESG, investment and sustainability, which are about putting the financial frame and the asset liability management at the center is something that we will still keep. So for us, it means increasing the duration of our fixed income portfolio, reducing our equity exposure, and looking even more into alternative investments, because there are some opportunities to invest today. Is AGCS developing any non-property damage business interruption cover against infectious disease for clients to cope with the new risk environment? We are, of course, always thinking about solutions. The question for me, and I'm not the expert, but the question is, what this crisis showed is that it cannot be only, it has to be some type of scheme because of the systemicity of it that includes a public and a private layer. And this is something that we don't have enough of. We have it in some countries, for example, in Germany or in France, we have some, state share of the response. It also exists in some Latin American and some Asian countries, modeled after actually some of the European public backstop. The question is indeed, should the insurance industry, and especially AGCS, develop non-property damage business interruption cover? How do you build the product if because it was not just the pandemic risk, it was the shutdown of the economy risk. So it's not only about the pandemic. It's about the decrease and the political risk or the politicization of the pandemic response. It is very different from one country to another. And it's also about the second round effect, especially the fact that we may not see some air carriers lift the ground for another 3 to 6 months in some countries. And this is something that is, of course, much bigger in size and magnitude of the damage and losses than just something that a shield policy could cover. So this is a big question, and we need a framework. And this is something that we're going to have to work on as an industry, but also working with the public authorities. If you look also at the vigilance mechanisms, and we have many issues in the instrumentalization of the WHO that are being exposed as we speak, and that we knew before, that are asking the question of whether a pandemic as a definition is the right parametric approach to ensuring this type of damage. So yeah, the questions are many, and it's certainly the time to start thinking about the aftermath of this crisis and to designing such solutions. Definitely, and we will be there. Have there been any significant impact to the financial trust of insurers in light of COVID-19 and recent stock market turmoil? I'm pretty sure that some of the insurers that were less strong than Allianz in the balance sheet are having a very tough time. Yeah, of course, I won't give you names, but there are some insurance companies that were in dire straits before. When it comes to their solvency and the strength of the balance sheet, and that will be certainly affected by the impairment caused by the capital market turmoil, but also by the lack of inflow of gross written premium, because there is a shock in gross written premium. So the risk of surrenders in the life insurance business of smaller actors, the risk of beyond insurance, some asset managers and savings managers that are at risk of rundowns. We've seen already some money market funds, etc. The rush for liquidity was very high. This is certainly one of the main impact of the financial shock aspect of the crisis. I think central banks are very good at safeguarding banks. They are less good at helping some of the less systemic asset or savings managers out there that have had a hard time. I don't see any other questions. If you have a question, don't hesitate to send it. I hope I answered all of the questions. Okay, so I would like to thank you all very much. I hope it was interesting. Thank you very much for the many questions and the exchange. Please do find all of our studies on allianz.com/economic research. If you have any questions, just send me an email, ludovic.sabran@allianz.com, first name last name @allianz.com, or send to your account managers and they will gladly liaise with me. If we can be of any help navigating this turmoil in specific sectors, or if you want to have follow-up calls, please don't hesitate also. Thank you very much again for your attention, and stay healthy, and good luck with the business. Thank you very much, everybody. Bye-bye.